Good evening, all. Ira Epstein, and here we are with your metal market wrap-up. And this wrap-up is for the first day of the week, a new month, October 2nd, 2023, and a new quarter. Going to get very interesting. All right. Let's give a round of applause to Speaker McCarthy. He did get a positive done. He was able to not get the government to shut down. It may cost him his job. It was a brave move. I don't know if anyone knows if Mr. Gates, I think that's how you pronounce his name, the far-right Republican that wants to control all spending and cut it. And by the way, I'm for what he wants to do. In terms of that, I'm not convinced I'm for him in the way he's going about it. But since he's getting nowhere, he thinks he needs more radical measures, and this might be one to do it. It's called politics, and you do what you got to do. But we didn't shut down. The markets at first got a rally in the morning, and then they gave it all up, and we saw the market start caving in. And even worse, interest rates soaring one more time. That interest rate soaring is weighing on the gold. You're into the 1840s. This is a number we were talking about a couple weeks ago that I didn't think we were going to. We're going to. And you can see silver. Is it going under $21? Copper's back into the 360s. The dollar soaring. It's up another 80 cents. Are we going into the 110, 112 area? That's very possible. And are we going to go back to the 102, 103 area in the euro? Another possibility. So foreign currencies against the dollar simply getting their butt. You know what? That is taking place as we're talking. All right. Let's go to a chart and understand what's going on. This is called a vertical price decline. And the market from the 1920 area, roughly, failed and just came on down. You're down $100 an ounce in very fast order on a weekly chart of just closes. Very important, though, is that when a market is underneath this 18-week average, I keep teaching you, you should have a downside bias. Think of it as the line in the sand. When you're above it, you want to be friendly. When you're bearish, you want the market under it, and that's what you've got. The filter is, it keeps me, I don't know about you, from telling my clients go long trying to catch a falling knife. You don't do that. I'd rather be on the short side of the market and wrong than the long side trying to catch that knife. Look at how this market has just gone into a state of collapse. Now, when we come on this chart, we can see that this all began closer to the 1970 area, and we're quickly down $120 an ounce. People that hung in there can't believe what's happening to them, and I'm sure they're talking to their broker themselves, one of the two this way. It can't keep falling. I know it's going to bounce. Of course it'll bounce. It'll let you out lower than you thought you'd get out if you bit the bullet right back here where you're supposed to. Once you got under this low, you broke the pattern. You had lower highs, lower lows, and the game came crashing down. You at that time were also underneath the 18-week average of closes. Where might the market go? Well, it's none of these moving averages. We had another bearish crossover where the 100 got under the 200 right back here, and that's been feeding on the market. So now you have a classic bearish setup. Now, what do I mean by that is what you got to ask yourself. You have the 18-day average of closes, the red, underneath it, the 100, and above that, the 200. You've got the short term, the medium, longer term, and they're lined up in a bearish configuration, one under the other. That's very, very bearish action. So where might the market go? The Bollinger Band is the most logical, and it hit it here. And from that point on, the market just went into a state of collapse. Did it embed? Embedding takes place when these two numbers, the red and the blue, go sideways under 20 for several days in a row. You can't count Tuesday because we don't know where the market's going to finish. So we go to Monday. Both numbers were under 20. The day before, they were under 20. The day before, not. So this is not a market that fell because of the embedded reading. It's just trying to embed. It's called, I label these, a vertical price break. And they just happen out of sometimes nowhere. They take on their own life, and you get a series of days under the Bollinger Band. Now, if you're under it today, it would be the fifth day. You got 1, 2, 3, 4, 5, 6 day. You rarely go beyond 5. Is that a sign of weakness or strength? It is a sign of continued weakness ahead. When this occurs, there's something bigger brewing on the chart. People are bailing big time. You generally also see, for those of you that follow open interest, the shrinkage in it is people just went out. They're wrong and they just went out. And then the bears come in later on the rallies. That's still what I expect to happen. Why? Because they see nothing to stop interest rates from going higher. And if rates go higher, it supports the dollar. The two of that combination is the enemy. If you've been watching me at all, I have been saying this like a broken record. The other thing I said, and I said it all last week, I don't know why we weren't down to the $1,700 level thereabouts a long time ago. I'm amazed that we weren't, and it appears we're in a catch-up phase in the market. When we look at the gold-silver ratio, I make this in the gold color because the higher this number goes, you need more ounces of silver to get an ounce of gold. So the silver market's in the toilet as well, and you can see. Now, it's nowhere near as quick and under the Bollinger Band in day after day occurring. And I don't think it has to occur. This market just got problems galore. And the trend is down, the bias down. Let it embed and we take another look at it. Do you sell oversold markets? I teach my clients not to. You might. Do you want to be short under Bollinger Bands? I teach my subscribers not to. You might want to, and I'd like you to do that because you're the guy that we want to attack. When we look at the copper market, I still don't know why it rallied last week. I mean, all I keep reading is the problems that the companies in China are having that are in property. Why is anybody buying copper? These companies are on the verge of failure, big time failure. Their equivalent of the SEC in China said that the deals that have been made to issue more stock along with debt to keep Country Garden and Evergrande open and others that are doing any deals with stocks, they're not going to allow. Well, that unravels all the debt deal. Then you've got, at the end of October, another part to this where the courts in Hong Kong might order the liquidation, final orders. Okay, you want to be long copper when that's happening? Not saying you shouldn't. My clients won't be on that type of thing if they follow my recommendations. In the platinum, it's doing what I thought. Remember this rally here and we were getting into the auto strike and I said, folks, I don't think you want to own platinum and palladium during an auto strike. And don't get me wrong, I realize cars, many of them are made outside of the United States. And if they have an internal combustion engine, they're using obviously mufflers, catalytic converters, all those type of things. And the catalytic converters, diesel or gasoline, platinum, palladium, it's got to be there. But in America, and that's what I'm looking at, the demand for those has to be falling as now we've got 25,000 plus strikers. And the plants are shutting down for the auto people. They've got plenty of cars on the lots they can still sell. And we have plenty of electric cars. This could be a boon for that time because you'll be able to get your car from Rivian, Lucid, so on with the normal backlogs if they have a backlog. In the dollar index, right up to the upper band. So you came down, and guess what? If you take a look at this market on Friday on the daily chart, you lost the embedded reading. That means it was a liquidation day on all longs the way that I teach charting. The only time you can re-embed, the only time is the next day if the market does that, and it did. Therefore, on pullbacks, I think that the bulls will come charging back into the market, and they'll bail if they lose the reading again under a 79, and until that's over, they'll keep looking for higher prices. So that was the pause in the market. It lasted 24 hours, and you're back into that type of trade as I see it. Now, our trading kit helps you with a lot of this because some of the courses that I have are in it. Other things that you get is the charting software, the way that I put together charting software with our type of indicators in it. You're going to get chapters galore. There's 10 chapters. Now, what we send you is a link. You open the link up. You can put it on your desktop. That's the ideal spot to put it. It'll open all this for you, and when you're through, just delete it and you're done. You can print out the chart pattern pages. They're great. You're going to get my pivot point course, my Arun indicator. You're going to get access to all the CME groups, different courses. I wrote this cause and effect when Volcker, you heard me, Paul Volcker, was the head of the Federal Reserve. It's as accurate today in what it predicts as it was the day I put it out. It explains M1, M2, M3, all the courses from the market. They cover a lot of this. They teach you fundamentals, charting, and so on. Why not take advantage? So if you're serious and you want to get your feet wet, and this is the time to do it, IraEpstein.com, free offers, or move your cursor up here, give a click. You'll see the icon and go from there. And if you have questions, just call my staff. During the day, they will pick up the phone. They will answer your questions. I'm Ira. You have yourself a great evening. I'll see you first thing in the morning.